Welcome to our deep dive on the portfolio lending war. In this video, we'll examine why chasing the lowest margin rate from discount brokers may actually be a costly mistake compared to using specialized pledged asset lines at premium brokerage firms. We will define key terms, compare structures, walk through a crash day sequence, run illustrative math, and give you a practical decision framework. Finally, we will test your knowledge with a brief quiz and wrap with actionable takeaways. Let's begin. Here's the plan. First, we'll set the context and define margin lending and pledged asset lines. Next, we will compare the two structures in a practical way. Then, we'll visualize the decision flow and what happens during a market crash. After that, we'll quantify hidden costs with an illustrative example. We'll finish with an evaluation checklist, a short quiz, and the key takeaways along with a disclosure. Let's move to the context. The core conflict for investors seeking liquidity is whether to prioritize the lowest possible margin rate or the structural protections and flexibility of pledged asset lines offered by premium brokers. Discount platforms dominate margin lending and often win on APR. However, PALs are relationship-based, non-purpose credit lines that may better insulate you from forced liquidations during severe drawdowns. With that in mind, let's define the terms clearly before we compare them. Margin lending lets you borrow against your portfolio to purchase more securities, often at very competitive rates. A pledged asset line, by contrast, is a non-purpose loan. You still borrow against your portfolio, but you cannot use those funds to buy securities. PALs are commonly used for liquidity needs outside the market, such as real estate down payments, tax obligations, or business expenses. The APR, or annual percentage rate, is the advertised cost of borrowing. While lower APR is attractive, it can distract from structural features like margin calls, covenants, and draw periods. Non-purpose loans cannot be used for securities purchases, which is a key compliance distinction that also changes how risk is managed by the lender. Now that we have the terminology, let's compare the structures head-to-head. On the left, discount broker margin loans typically show the lowest APR, are purpose loans intended for buying securities, and are managed with frequent mark-to-market checks that can trigger margin calls. In severe market declines, these features may lead to rapid forced liquidations. Relationship leverage tends to be limited. On the right, premium pledged asset lines may carry a slightly higher APR, but they are non-purpose loans and provide broader flexibility in how you can use the funds. Their covenants emphasize collateral quality and loan-to-value thresholds. PALs are structured to reduce the likelihood of forced liquidation during stress. Pricing is often negotiated based on your total relationship and assets with the firm. This makes PALs appealing for high-net-worth investors prioritizing stability over the lowest sticker rate. Next, let's visualize the decision process. This flowchart maps the high-level decision criteria. If your overriding goal is to minimize APR, the path leads to discount margin lending, with the understanding that margin calls and rapid deleveraging are part of the trade-off. If stability and avoiding forced liquidation are paramount, the flow directs you to a premium pledged asset line, highlighting non-purpose flexibility, relationship pricing, and typically longer draw periods. A hybrid branch reminds investors that they can split borrowing needs across structures to balance cost and resilience. Now let's unpack the hidden costs that a rate-only mindset can miss. 4 often overlooked costs are forced liquidation risk, tax friction, opportunity cost, and operational risk. Forced liquidations during volatility can lock in losses at precisely the wrong time. Realized gains taken to meet calls can create tax liabilities that further erode capital. The opportunity cost of missing a subsequent market rebound can be much larger than a 1 to 2% APR advantage. Finally, operational elements such as the timing of margin calls, wire transfer delays, and collateral haircuts can materially affect outcomes. To see how this plays out in real time, let's step through a crash day sequence. This sequence diagram contrasts a sharp down day under two structures. With a discount margin loan, the market drop triggers a margin call with a tight deadline. If the investor cannot meet it, the broker sells positions at depressed prices. In contrast, the pledged asset line, subject to its own covenants and collateral tests, often provides more breathing room. The investor may be asked to monitor or plan adjustments, but forced sales the same day are less likely. The result is that one structure frequently sells at the lows, while the other can ride through immediate volatility. With that real-time picture, let's quantify the trade-off with an illustrative scenario. Consider a $10 million portfolio with a $3 million liquidity need. Assume the discount margin loan is at 6.5% and the pledged asset line is at 7.8%. The spread is about 1.3%, which on $3 million is roughly $39,000 per year in additional interest for the PAL. Now simulate a market path where prices fall 25% and then rebound 30% within 6 months. In a margin structure, the investor is forced to sell $2 million at the low to satisfy margin. Later, they repurchase after a partial rebound, perhaps 20% above the bottom. By contrast, the PAL structure allows the investor to hold through the trough. Locking in a 25% loss on $2 million is a $500,000 realized loss. Avoiding that is significant. Additionally, missing a meaningful portion of the rebound exacerbates the gap. Even after paying the extra annual interest, the avoided forced loss can be an order of magnitude larger. These are simplified, hypothetical numbers to illustrate the dynamic, not forecasts or quotes. Next, let's organize the key differences in a table. This table compares features in an illustrative way. Discount margin lenders show lower headline APRs and are designed for purchasing securities, with frequent mark-to-market checks and margin calls that increase liquidation risk during crashes. PAL providers offer non-purpose lines with slightly higher rates, but with covenants and loan-to-value bands that can provide more runway. Draw periods are often longer and negotiated. Pricing for PALs is typically relationship-driven based on total assets at the firm. These are not quotes. They are generalized examples to frame the discussion. With that foundation, here is a practical evaluation checklist. To choose intelligently, first define the purpose of the borrowing. If the funds are for securities purchases, a purpose loan may be required. Next, quantify how sensitive you are to forced liquidation. What level of realized loss at a bottom would be unacceptable? Then stress test your collateral at documented drawdown levels to see when each structure would trigger covenants or calls. Compare the APR spread to the expected loss avoided by reducing liquidation risk. Evaluate operational aspects such as call timing, wiring speed, collateral haircuts, and draw periods. Use your relationship to negotiate pricing based on total assets and cross-product usage. Finally, consider a hybrid approach where part of the need is handled with margin for cost efficiency and part with a PAL for stability. Now, let's test your understanding with a quick quiz. Question: which statement best captures the core trade-off between discount margin loans and pledged asset lines? Option A: margin loans usually have lower APRs but higher forced liquidation risk. PALs may cost slightly more but provide more stability and flexibility. Option B: PALs always have lower APRs and no covenants, making them universally superior. Option C: margin loans and PALs are identical except for branding. Option D: PALs can be used to purchase securities directly, just like margin loans. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the first option. Margin loans often provide lower APRs but come with higher forced liquidation risk in volatile markets. PALs typically cost a bit more, but emphasize stability and flexibility through non-purpose usage, relationship-based terms, and covenants that can reduce the chance of immediate forced sales. This pie chart illustrates a hypothetical weighting of priorities for high net worth investors. Stability and avoiding forced liquidation receive the largest share, followed by the headline interest rate, flexibility from non-purpose usage, and relationship leverage such as negotiated terms across a broader asset base. While each investor will have unique preferences, the point is that the lowest rate is only one part of the objective function. Now, let's capture the key takeaways. The key takeaways are as follows. Do not confuse the lowest margin rate with the best long-term financings. PALs often exchange a slightly higher APR for greater stability and flexibility, which can reduce forced liquidation risk. The financial impact of selling at the lows and missing the rebound can be much larger than the annual interest spread. Use your total relationship with a firm to negotiate PAL terms. Finally, consider a hybrid structure if you need both the cheapest carry for some activities and the resilience of a PAL for others. Before we close, here is an important disclaimer. This content is educational and does not constitute financial, legal, tax, or investment advice. Nothing here is a recommendation to borrow, lend, buy, or sell any instrument. Rates, terms, and product features vary by institution and may change without notice. All rate figures and scenarios used are hypothetical and for illustration only. Consult your financial, legal, and tax advisors and review lender documentation carefully before making decisions. To conclude, let's summarize and wrap up. In summary, the lowest APR does not guarantee the lowest total cost once you account for crash dynamics, forced sales, taxes, and missed rebounds. Pledged asset lines emphasize non-purpose flexibility and can provide insulation from same-day forced liquidations. Design your borrowing plan around worst-day scenarios rather than best-rate scenarios, and consider hybrid structures to balance cost and resilience. Use your total relationship with a firm to negotiate PAL pricing and terms. Finally, thank you for watching. If this video was helpful, please like, share, and subscribe. We welcome your questions and experiences with margin loans and pledged asset lines in the comments below. Your insights help the entire community learn. See you in the next one.